there's a lot of consistency that's happened in the last, several weeks here in terms of the way the markets have behaved. The lumber to gold ratio has been unrelentingly moving higher. Now, why is that ratio interesting? Because lumber is a tell on housing, gold is a tell on fear. And when you compare the two to each other, it actually tells you a lot about risk conditions. And the fact that you're seeing lumber prices do what they're doing and housing doing what it's doing is all suggested that the bond move is justified, meaning the sell-off that we're seeing in treasuries, the steepening of the yield curve. That combined with ongoing weakness in utilities, combined with a lot of the cyclical sectors showing outperformance, you do have this, I think, very one-sided, strong sort of reflationary behavior that's taking place. You had a moment in time there around the GameStop craziness where it looked like that might pause, but obviously they came right back. And a lot of the comments from Powell and from Yellen and sort of on the political side as well are all confirming the notion that, again, it looks like the policymakers are going to get their wish. You're going to get inflation running hotter than most people may think. Bond yields are starting to reflect that. So all the conditions are still suggesting risk on is there. The only thing I would caution advisors on is risk on conditions are here in terms of the short term, but they've also arguably they're reaching a point where they're kind of stretched, right? In other words, there is a point where the bond yield spike is going to be harmful. There is a point where bonds will be more attractive than stocks. There is a point where the lumber to gold ratio will definitively turn. And all that might lead to some kind of an accident in the stock market. But at least in the near term, it seems like bonds remain the far more concerning area to most investors than stocks.